Welcome back, everyone. We made it through another week, and I have to tell you, I'm feeling that shift in the air again. You can sense it when you follow the conversations, when you watch the interviews, when you read between the lines of what lawmakers are saying and what they're not saying. I believe next week is going to be pivotal. I'm not guaranteeing anything, I'm not stamping a date in stone, but I am telling you that based on everything I'm seeing, everything I'm hearing, everything that's floating around out there, we are lining up for a serious move. I think we finally see that markup vote get locked in. I've been saying it, I'll say it again. By the end of next week, we should have clarity on scheduling. And if we don't, then we have to start asking tougher questions. But right now, I'm optimistic. This week was always going to be slow. People were back in their districts. Meetings were happening behind closed doors. Staffers were ironing things out. That's how this works. The public sees silence and thinks nothing is happening. That's not how Washington operates. The real work gets done when the cameras aren't rolling. Meanwhile, the markets are reacting to headlines like they always do. You've got geopolitical tension being discussed again. You've got talk about potential escalations overseas. You've got tariff drama resurfacing. And every time a headline drops, you see that knee-jerk reaction online, panic, excitement, fear. But then you actually look at the charts and you realize something important. A lot of this is already priced in. The tariff situation is a perfect example. The ruling comes out, people start arguing about legality, about authority, about whether refunds could be owed. And here's where it gets frustrating. We're hearing that if certain tariffs are deemed improper, companies might have the right to seek refunds, billions potentially flowing back. But wait a second. For months, we were told those costs were passed on to consumers. Prices went up, groceries went up, goods went up. Corporations reported record profits while explaining price hikes as necessary adjustments. So, if the money was passed down the chain, if the consumer absorbed the hit, then who exactly deserves the refund? That's the part that doesn't sit right. If corporations kept margins strong and protected shareholders while pointing to tariffs as the excuse for raising prices, and now those tariffs are in question, shouldn't everyday people be part of that conversation? Instead, what we're hearing is that large entities could reclaim funds while consumers just move on. That creates tension, that creates skepticism, and markets pick up on that emotion fast. But here's the bigger picture. Despite all the noise, despite the headlines, despite the geopolitical chatter and legal disputes, the broader market structure hasn't collapsed. Volatility spikes, sure, but underlying positioning remains steady. Investors are watching policy developments closely. They're watching regulatory clarity debates. They're watching how leadership handles economic messaging. And if next week delivers even a hint of forward motion, if we see scheduling confirmation or bipartisan momentum, sentiment could turn quickly. So I'm watching carefully, I'm listening closely, I'm staying grounded because sometimes the quiet weeks are the ones that set up the loud ones. And next week, it has the potential to be very loud. We should get our money back. That's the part that still sticks with me. If the costs were passed on, if consumers paid higher prices, if families adjusted their budgets because of tariffs, then how is it that corporations could be first in line for refunds? That's frustrating. It feels backwards. But like I said before, we're not here to spiral on that. We're here for XRP. We're here for what's actually moving the needle in this market, what's positioning us for the next real move instead of getting distracted by noise. And when I zoom out and look at the broader market right now, what do I see? I see the VIX cooling off. I see volatility dropping. I see the panic that people were screaming about just a week ago starting to fade into the background. That tells me something important. That tells me positioning is happening quietly. Smart money doesn't panic loudly, it rotates silently. I didn't expect anything finalized this week. I've been consistent about that from the start. This was always going to be a transition week, a recalibration week, a behind the scenes kind of week. Lawmakers back in their districts, staff drafting language, lobbyists refining proposals, legal teams redlining sections to eliminate loopholes. That's how this works. The public sees silence and assumes nothing is happening. In reality, silence in Washington often means the real negotiations are underway. The loud weeks are for optics, the quiet weeks are for structure. But next week, that's where it gets interesting. I'm leaning toward announcements early in the week. Sunday night leaks that start circulating on social feeds, Monday morning headlines that shift sentiment before the market even fully digests it, maybe Tuesday or Wednesday if negotiations stretch into the early part of the week. They usually try to have everything lined up before Thursday at midnight if they want a markup vote properly scheduled. That's procedural, that's logistical. Rooms have to be reserved, committee members have to be notified, draft language has to be finalized and distributed. Sometimes it bleeds into Friday, but typically Thursday is the internal target. They want it clean, they want it structured, they want no surprises. And from what I'm hearing, that's the direction this is going. There was a major meeting, more productive than people realize, not just surface level talking points, but actual negotiation, compromise language being discussed, stablecoin provisions refined, activity-based reward structures instead of passive yield models being evaluated, banking representatives rolling up their sleeves instead of just posturing, crypto advocates engaging instead of pushing ultimatums. That's a shift, that's progress. What people underestimate is how much pressure exists to get this done before the calendar tightens. Once summer hits, campaign season intensifies, cooperation drops, incentives change. Right now, there is still a window where getting a bipartisan framework passed benefits everyone. Miss that window, and everything becomes political theater. That's why I believe urgency is real. That's why the behind the scenes tone has shifted from exploratory to decisive. And the market senses it. You can see it in how XRP is behaving. You can see it in how volatility compresses instead of expanding. It's coiling. It's waiting. It's not collapsing under uncertainty the way it would if negotiations were truly breaking down. Instead, it's hovering, building pressure. That's what happens when traders believe something is coming but don't yet have confirmation. So, yes, the refund debate is frustrating. Yes, fairness matters. But the bigger picture right now is structure, regulatory clarity, institutional green lights. And if next week delivers even partial confirmation that the framework is locked in and a markup vote is officially scheduled, sentiment flips fast. Markets don't wait for perfection, they react to direction. And right now, direction feels closer than it has in a long time. So grab your coffee and settle in because this is where things get real. If you're following the probability trackers, the public market pricing still has the Clarity Act sitting around 71% odds of passing this year. That's not bad. That's actually strong when you think about how difficult major legislation usually is. But here's the part people aren't fully appreciating. 71% assumes momentum continues. It assumes negotiations don't stall. It assumes personalities don't clash at the last minute. And most importantly, it assumes timing doesn't slip. Because if they don't push this through in the spring window, the calendar becomes an absolute nightmare. Once summer break hits, campaign season kicks in hard. Lawmakers aren't just legislators at that point, they're candidates. Their priorities shift. Messaging shifts. Cooperation becomes politically risky. There are only a handful of meaningful legislative sessions left once you get into late summer and fall. They're back in their states more often than they're in D.C. Fundraising events, town halls, media appearances, strategy sessions, positioning themselves for re-election. And historically, when that cycle starts, bipartisan wins become rare. Nobody wants to hand the other side a headline that says they got something major done together. That's not cynicism, that's pattern recognition. We've seen it over and over again. So timing matters more than people realize. The difference between passing this in early spring versus trying to jam it through in late summer could be the difference between success and collapse. That's why this window right now is critical. That's why the urgency behind closed doors feels different. There's a recognition that if this doesn't clear committee and move to the floor soon, the political gravity shifts and it gets exponentially harder. And that brings us to pressure. If you've been calling senators, keep calling. I know people get tired. I know it feels repetitive. But sustained pressure is what keeps issues alive. Offices track calls, they track sentiment, they track volume, especially when amendments start getting floated that look like poison pills designed to derail progress rather than improve it. Those kinds of tactics thrive in silence. When constituents speak up consistently, it changes the calculus. Now let's talk about the ethics argument because this is where emotions run high. If someone wants stricter ethics rules for lawmakers, fine. Most people agree insider trading and conflicts of interest should be addressed, but apply it evenly. Apply it to stocks, apply it to crypto, apply it to everything, make it universal. The public will support fairness every single time. What people won't support is selective targeting of one asset class while leaving the traditional system untouched. That feels political, that feels strategic, and markets hate inconsistency. Consistency is what builds trust, and trust is what this market needs more than anything right now. Investors need to believe the rules won't shift arbitrarily depending on who holds power. Institutions need to believe compliance standards will be predictable. Retail needs to believe the playing field isn't tilted based on political convenience. When the framework is uniform, when the guardrails are clear and evenly applied, confidence rises, and confidence is capital. Capital is momentum. Momentum is price. That's the chain reaction. So this isn't just about one bill or one vote. It's about establishing a standard that markets can rely on. Get it done in the right window, apply it consistently, and you unlock stability. Miss the window, inject partisan maneuvering, and uncertainty lingers. And uncertainty is the one thing markets punish immediately. Now let's talk about what really has me fired up, because this is where charts meet catalysts and things can move fast. Shorts, XRP is coiled. I've said it before and I'll keep saying it because the structure hasn't changed. It looks like a spring compressed under serious pressure. Around that 1.51 level, you've got millions stacked in short positions. That's not retail guessing. That's leveraged positioning leaning heavily on a resistance line that traders believe will hold. And for a moment it did, until it didn't. We broke above it briefly, and what happened? Immediate squeeze, 10% in hours. That kind of move doesn't happen because of casual buying. That happens because positions are forced closed. That happens because liquidation engines kick in. That happens because stops get triggered in clusters. It ripped up toward 1.67 before cooling off, and that cooling off wasn't weakness, it was exhaustion from forced buying. Then price drifted back down, consolidated, shook out momentum traders, and reset. That's healthy. That's how markets reload. Now we're back in that zone again. Every time we approach 1.51, the pressure builds a little more. Think about it from a structural standpoint. Shorts feel confident because the level rejected price before. They stack again. They add. They assume the macro noise, the political uncertainty, the lack of finalized clarity will keep it capped. But the higher the compression, the tighter the range, the more explosive the release. If we get confirmation above it, and I'm not talking about a quick wick that gets sold immediately, I'm talking about a solid hold with volume, the next squeeze layer triggers. Now, that's how this works. It's mechanical, it's not emotional. Liquidity hunts liquidity. Above resistance, there are stop losses, there are margin calls, there are automated triggers sitting like dominoes waiting for that push. Once they start falling, price accelerates. And the beauty of this setup is that it doesn't require a miracle headline. It requires one credible piece of confirmation, an official markup vote announcement, a statement that votes are secured, a bipartisan agreement framework released publicly, something tangible that shifts probability perception from maybe to likely. If that headline hits, 1.50 doesn't just get tested, it gets blown through like tissue paper. And once that happens, the psychology changes instantly. Traders who were comfortable short suddenly scramble. Momentum buyers pile in, algorithms detect breakout strength and amplify it. The next resistance zones get tested rapidly because the fuel is already sitting there in the form of leveraged shorts. And here's the part people underestimate. When a squeeze starts from a coiled structure, it doesn't move politely. It expands volatility upward. It stretches candles. It forces reevaluation. That prior move to 1.67 showed what's possible with partial fuel. That wasn't even a full catalyst. That was just positioning imbalance. Now imagine that same imbalance paired with real legislative clarity momentum. This isn't hype. This is setup recognition. The market has memory. Traders remember that 10% burst. They know what sits above that line. So while price may look boring to impatient eyes right now, under the surface it's building tension. And tension in markets, when paired with a catalyst, doesn't resolve quietly. It resolves violently to the upside. And here's the difference this time. If regulatory clarity is truly locked in, If this framework actually gets across the finish line, you're not going to see the same deep retrace back into the low 130s like we've seen during previous runs. The structure changes and the psychology changes, the participant mix changes. Why? Because institutions step in, and when institutions step in, they don't trade like retail. They don't panic sell every 5% pullback. They accumulate. Once legal risk is neutralized, funds that were previously restricted from touching XRP can finally deploy capital. A lot of people underestimate how many compliance departments simply said no over the last few years, not because they hated XRP, not because they doubted the tech, but because unresolved legal classification risk made it off limits. Portfolio managers can't override that. Risk committees won't sign off on that. So capital sat on the sidelines. But once clarity is codified, once the lines are drawn between what falls under the SEC and what falls under the CFTC, once that gray area disappears, those same funds can move. Compliance teams give the green light. Legal teams update internal policy documents. Custody providers expand offerings. Prime brokers adjust margin rules. And that's where the real shift happens. The repeal of SAB 121 already set part of the stage by removing the punitive balance sheet treatment for banks holding crypto on behalf of customers. That rule discouraged participation because it forced institutions to treat custody in a way that inflated liabilities. With that gone, the door opens wider. Banks won't be penalized the same way. They can provide services without artificially damaging their balance sheets. That matters more than people realize. Think about what that means structurally. When banks are comfortable offering custody, institutional clients feel safer allocating. When custody feels safer, larger allocations follow. When larger allocations follow, dips get bought instead of sold aggressively. That's how floors get established, not by hype, not by influencers, but by balance sheets absorbing supply. So, yes, retail is impatient. I get it. Up, down, sideways. It feels exhausting. It feels like every rally gets sold and every breakout fades, but we are in the waiting room of something bigger. Waiting rooms are uncomfortable. They test conviction, they test patience, they shake out weak hands, but they also precede movement. Negotiations are real. Stablecoin language is being refined carefully. They're redlining drafts to eliminate loopholes because the last thing lawmakers want is unintended consequences that blow up later. Activity-based rewards instead of passive yield structures are being discussed as compromise solutions. That's not stagnation. That's constructive dialogue. That's two sides recognizing that innovation and safety can coexist. Credit cards offer incentives, cashback programs, points, rewards, and they didn't destroy community banks. Innovation didn't wipe out the system, it integrated into it. The same principle applies here. Crypto and banks are not natural enemies. They can coexist. They can complement each other. Banks provide infrastructure and compliance. Crypto provides efficiency and innovation. Together, they expand the financial ecosystem rather than cannibalize it. If clarity lands, this becomes less about speculation and more about integration. And integration is what sustains long-term price floors. That's the difference this time. Not just another breakout attempt, but the potential beginning of structural participation. This isn't banks versus crypto. That narrative is outdated and honestly too simplistic for where we are now. That's small thinking. What we're witnessing isn't a cage match between old finance and new finance. It's infrastructure evolution. It's the financial system upgrading its plumbing while still keeping the same house standing. The banks aren't going anywhere. Crypto isn't going anywhere. The question isn't who wins. The question is how they integrate. If the bill passes, the coordination between the SEC and the CFTC becomes clearer. Lines get drawn, definitions get codified, commodities classification gets structured instead of debated endlessly in courtrooms. That alone is massive, because what has weighed on XRP for years wasn't technology risk. It wasn't adoption risk. It was legal ambiguity. It was the constant overhang of what if? What if another enforcement action comes? What if classification changes? What if exchanges face pressure again? That cloud suppressed valuation. Markets price in uncertainty aggressively. When regulation by enforcement fades and regulation by definition replaces it, that cloud evaporates. The legal uncertainty that acted like a ceiling disappears almost overnight. Now, that doesn't mean price explodes infinitely in one day. Markets still digest. They still test levels. But the psychological barrier breaks. And once psychology shifts, capital allocation models adjust. Over the following months, not necessarily day one, but gradually, capital flows in. Large firms don't rush in emotionally, they move methodically. Investment committees meet, risk parameters update, legal teams review finalized language and issue internal memos. Portfolio managers get approval thresholds adjusted, and then allocations begin. Maybe small at first, a percentage here, a fund exposure there. But once the first wave starts and performance follows, others replicate it. That's how institutional momentum builds, quietly at first, then visibly. And when institutional money starts entering consistently, retail notices. Retail always notices. Performance attracts attention. Attention attracts headlines. Headlines attract new participants. That's when FOMO kicks in. That's when cycles accelerate. It's not magic, it's liquidity layering. Institutional capital provides the foundation. Retail enthusiasm provides the velocity. Together, they create sustained trends instead of short-lived spikes. Now layer in potential macro catalysts. There's talk about stimulus mechanisms, tariff refund checks, various forms of consumer liquidity being floated politically. Whether it's framed as economic relief or election year incentives, the effect is the same. When money hits consumers' accounts, a portion of it flows into discretionary spending and a portion flows into markets. It always has. After prior stimulus waves, risk assets benefited. Crypto especially benefited because it's accessible, global, and trades around the clock. Liquidity is fuel, structural clarity is ignition. When both align, acceleration happens faster than most expect. And remember, this isn't just about XRP in isolation. Broader market sentiment shifts when regulatory risk decreases. Ethereum benefits, Bitcoin benefits, exchanges benefit, even equities tied to digital assets benefit. It becomes a sector-wide repricing event. So this moment isn't about choosing sides between banks and crypto. It's about recognizing that the system is adapting, the rails are being upgraded, and once those rails are locked in, capital moves more freely. Money in consumers' hands eventually finds risk assets. Money in institutional hands eventually seeks growth exposure. That's not speculation. That's historical pattern. And if clarity arrives alongside liquidity, the next phase isn't just a bounce, it's a transition into integration-driven expansion. And don't underestimate the global angle here, because this isn't just about domestic policy or a single asset ripping on a chart. This is about positioning in a world that is rapidly digitizing its monetary infrastructure. Stablecoins backed one-to-one by U.S. Treasury bills do more than provide price stability for crypto traders. They create structural demand for U.S. debt. Every dollar issued in a properly regulated stablecoin backed by T-bills represents real buying pressure on short-term government securities. Multiply that by billions and potentially trillions over time, and you're talking about a steady programmatic source of demand for U.S. debt instruments. That matters because the United States runs on debt markets. Borrowing capacity, interest rate stability, and global reserve currency status are all interconnected. If stablecoin issuers are required to hold treasury bills as backing assets, that strengthens the dollar indirectly. It deepens liquidity in U.S. debt markets. It supports financing operations. In a world where geopolitical competitors are actively trying to reduce reliance on the dollar, that's not a small detail. That's strategic leverage. Now, flip the scenario. If the U.S. fails to create clear regulatory rules while other nations move forward with well-structured, yield-bearing, asset-backed digital currencies, capital doesn't just sit still, it migrates. Markets are global. Liquidity is global. If another jurisdiction offers regulatory certainty, attractive yield frameworks, and clear compliance standards, institutions will explore those opportunities. Funds will allocate where the rules are predictable and the returns are competitive. That's not exaggeration, that's strategic competition. Countries understand that digital currencies are not just technological experiments, they're financial infrastructure plays. If foreign stablecoins are backed by gold, commodities, sovereign bonds, or offer structured yield within a clear legal framework, they become viable alternatives for global trade settlement and cross-border liquidity. And if that happens at scale while the U.S. remains in regulatory limbo, dollar dominance faces incremental erosion. So yes, this bill matters far beyond crypto charts and short squeezes. It affects equities because stability in regulatory frameworks reduces risk premiums across sectors tied to digital finance. It affects debt markets because mandated treasury backing increases structural demand. It affects dollar strength because global participants prefer assets tied to transparent, enforceable systems. If it passes, stability increases, not perfection, but clarity, and clarity lowers uncertainty discounts. Risk assets likely rally across the board, not just crypto. You'd see confidence return in fintech equities, digital asset custodians, exchange platforms, even traditional financial institutions expanding into blockchain services. The narrative shifts from uncertainty to innovation leadership. If it fails spectacularly due to partisan games, however, expect volatility to spike hard. Markets hate wasted momentum. They hate political dysfunction that interrupts structural progress. A breakdown would signal that consensus is unreachable even when incentives align. That kind of signal amplifies risk perception, and risk perception drives capital out temporarily. Yeah, this isn't fear-mongering, it's acknowledging scale. Digital asset regulation is now intertwined with macroeconomic strategy. The world is watching how the United States handles this transition. Leadership here strengthens global financial positioning. Failure introduces cracks, and markets respond quickly to cracks. Right now, I'm watching that 1.51 level like a hawk, not casually, not emotionally, strategically, because levels like that aren't just numbers on a chart, they're pressure points. They represent positioning, they represent conviction, they represent where traders have drawn a line in the sand and said, this is where I'm willing to take risk. And when a level like that gets tested multiple times without collapsing, that tells you something. It tells you there's absorption happening underneath the surface. At the same time, I'm watching negotiations. I'm watching every public statement, every carefully worded comment, every shift in tone, because policy momentum and price structure are moving in parallel right now. Odds markets fluctuate daily, but people misinterpret that volatility. When you see percentages drop from the mid-80s to the low 70s, it doesn't automatically mean fundamentals deteriorated. Often it just means traders locked in profit on their prediction positions. These platforms trade like markets. People buy low, sell high. That movement doesn't necessarily reflect collapsing confidence. It reflects trading behavior. And here's what I find interesting. Some insiders, some of the voices closer to the process, are far more confident than the public percentages reflect. That gap between internal confidence and external pricing is where opportunity lives. Markets are not always perfectly efficient in real time. They adjust as confirmation arrives. We're on the 2 yard line. That's how it feels. Not midfield, not deep in our own territory. Close enough that you can see the end zone. Close enough that execution matters more than strategy at this point. Could something derail it? Of course. Politics always carries risk. A late amendment, a procedural delay, an unexpected coalition shift. We've seen momentum stall before. So nobody should pretend it's guaranteed. But momentum feels real. The tone has changed from confrontation to refinement. That's important. When negotiations shift from arguing over whether something should exist to refining how it should function, that signals maturity in the process, and markets respond to that subtle change long before headlines scream victory. If it crosses the goal line, Ethereum, XRP, Bitcoin all get structural tailwinds, not hype-driven pumps. Structural tailwinds, the kind that reduce risk premiums and invite new classes of capital. Ethereum benefits from clearer treatment of decentralized protocols. Bitcoin benefits from reinforced commodity positioning. And XRP, in particular, benefits from something deeper. For XRP especially, clarity removes the last major psychological barrier. For years, even after partial court victories, there has been that lingering hesitation, that quiet doubt among institutions. That question mark about future enforcement posture, when that disappears, the narrative flips completely. It stops being the asset that survived legal battles and becomes the asset positioned for institutional integration.